All right. This is actually me. It's actually me on my crystal ball. So Adam, I don't know about you, but like every morning I wake up, I get it out of its little sleeve that I hide it in to keep it nice and protected. I rub it. Sometimes I give it a little smooch, make sure that, crystal ball is taking care of me. It's telling me everything. So I'm going to walk you through exactly what's going to happen for the next 6 to 12 months because my magic ball has told me and it never lies to me. First one off the bat, please really take this into consideration. There's going to be more variance in all market segments. And what I mean by that is you'll see very similar homes on the same block take totally different times to sell and sell at totally different prices. We are down a little over 24% from our all-time highs, right? People are, oh my God, price is down 25%, right? And it's just people are expecting prices to go down significantly beyond that. And it's just like another 25% drop from where we're at now would be like so significant.
All right, everybody, welcome back to Canadian Real Estate Channel. My name is Adam J.D. Martin, and today I'm going to be hosting Mr. Zack Brittain from Phipps Brittain, and we're going to be giving you the market update with using stats from October, and we're going to be thinking about what's actually going to be happening for the next 6 to 12 months in our market. So, Zack, what's been going on here in Waterloo?
Oh, brother, Waterloo has been a ton of fun. Market has been a little weird. Hey, the spidey senses started tingling in the summer. The fall has been strange. I want to talk just two really key pieces of data in Waterloo Region. I want to talk ADUs and tiny homes. I got an event because we got details we're sharing for that. And we've been having a lot of conversations on kind of positioning or repositioning, what to do with portfolio, done a lot of portfolio analysis. A lot of people from the Canadian Real Estate Channel, a lot of our past clients and our active clients, something we've worked through the last 6 to 12 months a ton, especially because the market's been shifting so much on the financing side as well, is like, okay, well, what are we doing for the next 3 to 5 years, given what we know now about the market? So we'll get into that. But yeah, I'm pretty pumped to get into it. I don't love going like super deep on the numbers necessarily on the presentations. There's a lot of data out there, but we will get into what I think is kind of really important at a high level. To start though, we do have an ADU tiny home event, dates booked, permit closed, property finished up. We actually just went on, Kevin Boland at King Street Construction built this ADU for us, and he just got front page of the local newspaper. I was like, heck yeah, he sent me the article today, so I had to update the presentation, but there's the ADU we're building right now. We're going to go over my crystal ball. So Adam, I don't know about you, but like every morning I wake up, I get it out of its little sleeve that I hide it in to keep it nice and protected. I rub it. Sometimes I give it a little smooch, make sure that, crystal ball is taking care of me. It's telling me everything. So I'm going to walk you through exactly what's going to happen for the next 6 to 12 months because my magic ball has told me and it never lies to me. And then ROI and return on equity. This goes into kind of analyzing portfolios, and then bigger deals. Go bigger, get bigger deals. We're going to be talking about getting into those bad boys.
All right. I love it, man. I'm very excited to see your crystal ball. Mine's been broken for a while, so I guess we'll be chatting about that.
All right. So here's some photos of the ADU. All right. We're going to get we got to finish off the landscaping when the snow's gone. It's getting a little bit too cold for us, but here's a quick snap of the inside. Open concept living area, vaulted ceilings, got the pot lights, got the big island. Lots of windows for the natural light, 2-car parking, right? I had to show it off. We got the media back. It's looking. We even snuck in a double vanity. What? I live in a century home. You don't have room for double vanities in these old century homes downtown. This is luxury, bro. This is bigger. This bathroom is bigger than mine, for crying out loud. So, we did upgrade a few things on this one because we wanted to figure out like what the best kind of use of space was, but we also kind of thought about like who our target market was when we're doing some of these things, like the vaulted ceiling, like the bigger bathroom. Like this is calculated, my friend. So events, there's going to be a link in the description for the events that you guys can register. It is limited capacity. This isn't a 4,000 square foot mansion, but it is an 800 square foot detached structure. December 13th and 14th from 7 to 8. We're going to go through just a quick mini presentation on, identifying potential options, the key things you need to know about what types of properties these can work for and make sense for, the numbers behind that as well. And then Kevin's actually going to come in and talk about building costs, logistics, options, what works, what doesn't, why we did specific things with this one. So if you're an investor or you're a homeowner thinking about utilizing an ADU, whether it's for extended family or boosting rental income or just utilizing your large yard, there's a ton of opportunity in this space for investors, but also owner occupiers. And I know I've been talking about it a lot on the channel, but in-person event, if you guys can't make it, I will book a private tour because the unit is not tenanted yet. So if somebody says, hey, Zach, I really want to come down and check it out, I'm thinking about XYZ, no problem. Send me an email. My email address is right there, but all the information for the events will be right down in the description of the video. I'm just pumped that we're finally done and we can show it off. So I'm really looking forward to sharing it with everybody that wants to come take a look.
That's a gorgeous building. It looks exactly like my brand new build house that I was living in last. And I absolutely love your attention to detail on some of those things. Like the lighting's fantastic, great windows, double vanity. Like these are the types of things that I'm sure people would love to learn how to do, because that's a very attractive asset. Like that's a gorgeous place to live. And I'm sure that would be extremely rentable to a lot of the market. And I think really the confusion and why people aren't just jumping on top of ADUs is they don't understand the process. So if you can take that guesswork out of it by going to an event like this, then I think that's a no-brainer, right? And think of the cost savings between building something like this in an existing property that you already have versus actually going and acquiring a new piece of land, getting all the permitting to start building and doing all that. You already have the properties, you already have the land. You can just start doing it if you knew what to do. So I think this is a really great opportunity for people to go and learn.
Likewise. And that's a big thing too, is there's a lot of people that have done really well. They've acquired property. And it's just utilizing the property that you already have as best you can and utilizing that, the equity and the cash you already have in a deal. There's lots of ways to finance these. There's lots of ways that you can have them built. They don't all have to be 2-bedroom. You can do 1-bedroom or bachelors. You can do basements, no basements. We've gone through, this is the second one we've built. This is the first one that we can kind of showcase. It's vacant. It's easy for us to show off. So I'm pretty pumped. We've had a lot of really good questions, and I know it's very situational, but like you said, Adam, understanding the process of it. So then you as the investor or the homeowner can really go back to your own situation and think, oh, now that I understand how it works, how does it apply to my specific situation? Just helps really give you guys the information to make a decision, whatever that's going to be. So we're pumped to show it off. We're going to be sharing some videos on our social media on it as well. If you guys want first dibs, I'm emailing this out to the investor hot list before this video goes live, so they'll get first dibs on this. If you want to go to the event, if you want to go on our investor hot list, it's a weekly email with on-market and off-market deals and commentary by me. Goes to your inbox once a week. Go to our investor hot list. There's a link in the description. It's on our website. You can leave me some notes as well for the types of stuff you're looking for, any conversations you want to have. And again, this goes right back to me. So you get access to me if you have questions and concerns. And I snuck in there at the bottom, actually, donuts. I eat 100 donuts a year, Adam, and I need one a day until the end of the year to hit my mark. But we auction off the last 10 donuts for charity every year. So my network, a couple people from the Canadian Real Estate Channel reached out last year. They're in the GTA, so I was I can't make the drive to give you guys a donut for the GTA. I got a baby now. I get killed if I'm doing that. But I think the big thing is just, one, I love donuts. Two, my community's been so good. We donate pretty much over $1,000 every year to the local food bank right around Christmas. There's a lot of people out there that could use a little bit of love this year. So if you guys have questions about donuts, I'm also your guy there.
That's awesome, Zach.
I'm a skinny guy. You can't tell. I've been working out a little bit, but I'm a pretty thin guy. I could pack away the donuts, boys and girls. So, all right, the goodies. If you're only here for the numbers, me and Adam, we're going to crush through this real quick. But after, I really want to have a conversation about the supply and the demand side of real estate and what's happening in both those worlds. So if homeowners out there or you investor guys and girls are kind of thinking about what your next moves are, get a context on both sides of this fight. You guys know me, I'm an artist. I put fancy lightning bolts up there to kind of mark where we were at in 2021, being so close to where we're at now in 2023 in terms of average sale price, right? These are single family, all the property types, and then the condo, townhouse, semis, all that. Long story short, Adam, I have to remind people how crazy a 5% shift in a month in a market is. Insane. So like these crazy ups and downs, guys, like this is a 4-year snapshot, a three and a half year snapshot. Like if you looked at any 3.5 year snapshot aside from the last 5 or 6 years, it's like pretty slow and steady. There's not these big blips that you're seeing. Like this is an abnormality. And so we're at about 815 average sale price for all property types. That is literally within 10 grand of what it was in October on 2021, 2 years ago exactly, right? So values fairly similar to where they were then. And if you take out, like I hear lots of like, oh, well, the market's down 40% from their all-time highs, right? Well, all-time high was 1 or 2 months in like January and February in 2022. And it shot straight up and shot straight down. And so what I wanted to get at with this was just be very cautious about the data and the numbers that you're like taking to heart and listening to. Like look at the whole picture and please come up with your own interpretation of it, because like I see lots of posts for whether it's other people in the business or investors or people in news, people in business and economics. And it's just like, take data with a grain of salt. We are down a little over 24% from our all-time highs, right? So people are, oh my God, price is down 25%. Right. And it's just people are expecting prices to go down significantly beyond that. And it's just like another 25% drop from where we're at now would be like so significant. A 25% drop from where we're at all-time highs. Yes, significant, but that was such a small piece of our market. Right.
Yeah. Yeah, so, I don't think it's worth even necessarily including that data. Like if you were going to look at if you actually tried to like forecast the future, then you actually wouldn't include this data. Like I have a degree in international business management, part of which was studying advanced statistics, and a stat like that would absolutely be removed from the data set. Context, it actually matters a lot here, right? So like barring another global pandemic that's unprecedented where we don't actually know how to respond, and the consumer behaved a lot differently during that period of time than they ever have. And so like barring an event like that happening again in a very near period of time, it's really hard to use that data given that context. So I think you're absolutely correct in that. And I would honestly ignore that data, delete it from your forecast to actually see, what's happening in the market. And again, even just looking at this few years here, delete that data. The chart looks perfectly predictable, right? It's doing basically what it should.
Yep. You're gonna get a little bump up in the spring because there's more activity and there's more people that are making moves, right? But and that's like seasonal norms, not just like long-term value trends, right? And like I said earlier in the video, that's like 5% months, guys. That's insane. But people are so desensitized to how like aggressive these moves move up and down that people just kind of, oh yeah, market was up 5% last month, and you're just like, 5% month over month is wild for a residential real estate, any real estate market. That is wild. So I just want people to really understand like long-term concept and getting all of the information to make a decision. People are like, well, what are values like? That is like, yes, that is an important piece of information, but with no context and no other supporting information, it's like, so what? So next thing is that I really wanted to cover was supply, right? And like, man, real estate is really good at making charts sexy and interesting. I'll tell you that for free, right? Jesus, guys. So where we're going with this is, I've said this before, we had 7 straight years of supply below 2 months of inventory. And what that means is if no new homes came to market, we'd just be sold out in 2 months. There's no homes to sell, right? Below 4 months of inventory is considered a seller's market. There's more sellers than there are buyers. Around 4% is balanced. Above 4 months, above 4 months is a buyer's market. There's so many properties out there. Buyers can buy where the heck they want. There's lots of choices, right? Well, we hit 2.6 months of inventory, which was back in September, and then we hit the same in October. So we have over 2 months of inventory for the first time since 2015. Wild. Well, you would think that would mean we are acting like a seller's market because we still have well under 4 months of inventory, when in fact we have low supply, technically speaking, but we're acting more like a balanced market. Right? Some buyers are getting conditional offers accepted. Some sellers are still selling in multiple offers. Some properties are sitting longer, taking longer to sell. Some properties just aren't selling at all. We're getting a big old mixed bag of something and nothing at the same time. And so what I want people to understand is, though, even though our inventory is still historically low, expectations and interest rate environment, overall economic environment are playing much bigger roles on what's happening in our real estate market right now. And we're going to see a few things on both the buyer side and the seller side that we'll get into right now with Adam. And like, for the demand side of real estate, I just want kind of the viewers to follow us through this conversation and just kind of think. Just give your mind the space to think about this for a second, ladies and gentlemen. If financing in the last year and a half has gone up dramatically, very quickly, and much higher than people were expecting, right? Now, if financing is up and majority of people that are purchasing real estate, whether they're owning it to live in or they're buying as an investment property, they have to finance it. So if financing your purchase is more expensive, less people are going to be interested in it because it's going to be less profitable, or some people will get taken out of that market entirely because they can't afford financing now, right? And affordability to purchase is going down because it's just straight up just more expensive to finance a purchase now. Okay, well, what happens to rents in that scenario, Adam? Right? Like, if it's more expensive to purchase a home, are less people going to buy?
Yeah, I mean, absolutely. Rental demand goes up.
Boom. Right? And so if rental demand is going up because some buyers are being like, hey, I can't afford it at these rates, or I don't like it at these rates, or I don't know what's happening, so I can't make a decision, there's more of that going on, right? And I think for what happens next is, okay, there's a lot more buyers that are being like, hey, you know what, Zach, hey, Adam, I don't know if the scenario that I had in my head and that I was running my numbers at 6 months ago makes sense now. So I'm going to do that again. And then I'm going to figure out if this is a market that I can play in. Okay. As they're doing that, sellers are bringing their property to market and they're stacking up in inventory. As inventory start to stack, buyers out there saying, hey, Zach, hey, Adam, maybe there's more deals coming out next month. If I don't find a home run deal this month, no worries. I think there's more coming up there in December. I'm just going to see what's out in December if I don't find a killer deal right now. I can't blame them. I'm the same way. If I think there's a better deal tomorrow and I don't have a bird in hand today that's unreal, all right, I'll just see what deals are out there tomorrow. And buyers are seeing that inventory is slowly coming up. So buyers are just saying, you know what? I like that one, but I think it's either going to be better next month or I think I'm on a better deal in a different area next month. So I'm just going to see what happens, right? And so buyers are a little bit more picky because their expectations are there's more deals coming out tomorrow. Big time. And on the investor side, investors, I'm you guys too. So is Adam. I'm thinking the same thing. If I have to adjust for how expensive financing is, and I also have to adjust for the unexpected for the next 6 to 12 to 24 months, all right, well then, until I can make a decision that is just a no-lose situation or makes just so much logical sense with all the uncertainty I have, then I'm just going to be sitting pretty. I'm going to say, you know what? Yeah, I can find a pretty good deal now, but if it's not a smoking, like hot, no-lose deal, yeah, I'd be more inclined to wait. Whereas 2-3 years ago, anybody that could get even anything that was remotely close to a fair deal, they're taking it because the market was going to go up $50K next month. So what the hell do they care? And so I just really wanted to communicate that the demand side is cooled and been taken out of the market a little bit, but it's not gone. Like, the market's not stupid. A lot of buyers and investors out there, they know what's going on. They know that there's going to be a few more listings coming up, inventory stacking. Yeah, interest rates probably aren't going to get that much worse, but if there's more deals coming out, then maybe I'll scoop one up. And so I think investors are really pumping their brakes in the sense of like, I'm going to see which way this is going. And I've even felt myself that I did less investing activity personally this year than I did every year previously. Repositioning properties, opportunity in the market, financing situations changing up, investors and partners changing up as well. Like, this is a big shift. And I think that like what I'm seeing, a lot of this is very, very true. And I want to go over some specific instances that we're starting to see more often before I kind of give my final prediction. And then we'll do the supply side first. I had to put this one in. I was thinking about how do I communicate this well? I was like, how motivated are sellers really? Right? You have experience. Did you wholesale, Adam, too, or no?
Yeah, I think I built probably Canada's largest wholesaling company.
That's what I thought. And so a big challenge for wholesalers is, seller expectations sometimes.
Absolutely.
Well, I've been hearing that sellers' expectations on my side as a realtor, yeah, they're a little high. They want that sexy 2021, 2022 price instead of today's 23 price. And sellers on the off-market side are very similar. No, they saw their neighbor sold, they don't care when, but they sold for 600K and their house is bigger than that. So they expect that or more.
Yeah, people often suffer from an effect called the recency effect, which, you see the most recent data that you've seen or paid attention to, particularly if it stood out as a benefit to you. That's the thing you're going to hold on to. And I think that a lot of sellers right now need to absolutely take into consideration that it's not 2021. And in fact, the numbers have changed. And, that's the kind of the point of these market updates, is to watch where the ball is right now, so that at least for us watching on the channel, we know how to position our properties and what we need to do to make them marketable, and then also manage our expectations when we're looking to sell or buy.
Yeah. And so I've had more questions from agents and from buyers and sellers on like, oh, well, did you see that property? Like, how can they expect to get that price for it? Or, oh, they've been on the market forever, they overpriced it from the beginning. Lots of comments like that. And really it comes down to, one, how educated a buyer or seller or investor is, but also, how motivated are they to really get a deal done? Like, and look, I'm making broad brush strokes on what I think about the market here. And it's different in different cities and different segments of the market. But like, how motivated a single family seller is that's selling their primary residence versus investor who's got a portfolio of 5 to 10 properties trying to offload one of them, they're going to be a little different. How motivated the seller, how bad the seller needs that money versus how bad that single family seller needs to sell the home, whether it's financially motivated, whether it's lifestyle, whether it's work, whatever. Totally different ball games. But I think you see a lot of sellers that say they're motivated, but they really aren't. They're motivated for the right price, and price motivation isn't always the strongest motivation necessarily. And what that's going to do is it's going to cause a few things that we'll talk about in one of the next slides on. I think next up real quick, just builders and developers. They're checking themselves. They were checking themselves 2 years ago before this kind of started happening. Now they're really feeling the adjustments of higher lending environment, cooling demand. I think a lot of them have already come out and saying we're delaying projects, or we're repositioning projects, or we're just not doing projects at all anymore. And what I think is going to happen is we're really going to fall behind on new housing starts, and we're trying to start to incentivize them by reducing HST requirements, trying to incentivize building of new rental units. But at the same time, the amount of time it takes for an incentive or a government program, an initiative to actually start impacting the end user, renters or owners, is very delayed. Years and years and years and years and years. And so I think builders and developers have pumped the brakes with this more expensive financing and with this cooling demand. But goddamn, do I hope they start building some more units. We need them bad.
Well, the reality is all of these programs, well, a lot of government programs, you end up having to put out the cash first, and then you get back a reimbursement for the government. So that causes some hesitation or pause. The other thing that is just very apparent in our market is that the Canadian government has said that they want to stay on target for another 500,000 for immigration. So, it's hard to have both of these things, because yes, you're right. Builders are slowing down. They're actually checking themselves and thinking, there's cooling demand. Financing's more expensive. Maybe some buyers are feeling the pressure of things that they had already put deposits down on. Maybe they're starting to try and pull out of these deals. Yeah. And that's one thing, but we actually still do have a supply issue, right? And if we continue to bring in 500,000 people into a country that has 34 million or something, that's a very large increase in population, and they're going to flock to certain areas, and Waterloo is certainly going to be one of them. And so it's just, that is a double header, man. And these government programs, to your point, are very slow, and I don't think the builders immediately benefit from them. So it's going to be fascinating to watch what happens there. Maybe we'll get into that with the crystal ball, but that's
my crystal ball only tells me that supply is going to continue to be a freaking problem.
Yeah. Well, I mean, building is not getting faster. How about that? It's just not.
Not.
And it reasonably won't get that much faster, because you would have to cut a lot of red tape, which takes a long time in the government to begin with, or have massive technological improvements on how we actually build houses, which,
yes.
We really don't.
Make it more efficient or more affordable, or both, so more people could do it, or we could do it at a larger scale. And
yeah, but those techs cost more at the beginning anyways. So it's you can't really win if we're going to yell about price and also supply and also have that much immigration at the same time. So
we will yell about it all, Adam. We will yell about it all.
Yeah, that's right.
So I think in like, just to go back to my comment about the wholesaling and the expectations for sellers on market and off market, is like declining values do impact supply as well. A builder is going to be less likely to bring out all these new units if their expectations when they were building them and selling them, or I'm going to sell them for $1 million, but I can only sell them for $850 now. They'll be less inclined to want to bring more supply to market immediately. Same with a seller who's thinking, like, look, we got an aging population. My mom's mid 60s. You know, she's probably getting close to thinking about maybe selling the big family home and downsizing and retiring soon. So if I told somebody, yeah, well, I'll sell your home for $1 million 2 years ago, and now I'm like, yeah, you get 800 for it, hypothetically speaking. They're like, well, I don't need to move right now. Why don't I just say, hey, maybe I just wait until the market comes back and make myself an extra 100 or 200 grand just for sitting in the same home that I still can maintain well. People are going to start staying in their homes longer. That's going to keep some supply off the market as well. There's more friction, it's more expensive, and there's more on the table for them to gain by holding their property longer. So I think the values taking a hit do impact the amount of people that are motivated to sell, truly motivated to sell. And so kind of just things that we're seeing in the market already and that I expect to see more of. First one off the bat, please really take this into consideration. There's going to be more variance in all market segments. And what I mean by that is you'll see very similar homes on the same block take totally different times to sell and sell at totally different prices. Whereas previously, when there's more market consistency and more consistency overall in a market, you're like, okay, I could tell you when I first got in the business what a home is going to sell for within $5,000 and like be pretty dang close almost every time. Right now, not that you can't do that. It's just, like I said, you'll literally see the same house on the same block sell within a 60-day window, take totally different timeframes to sell for totally different prices, some conditional, some like, it's just way more inconsistent, right? What that'll lead to is, again, more days on market. On average, properties are just going to take longer to sell. Not every property is selling in a week or two or less, guys. It's just not, right? Especially once you start getting up into the higher price points or you're into multi-units, doesn't sell in a week or less typically. You're going to see more conditional offers too, Adam. For single family homes, there's lots of condition for the sale of the buyer's property. We're seeing some more of those SBPs. We're also seeing lots of financing and inspection conditions. Those are being a lot more normalized, a lot more common, especially in larger detached homes or newer properties as well. We're going to see more incentives for the pre-con market. Developers and builders are going to try and get your deposits and trying to sell some more properties to lock in prices. They obviously need that to meet financing obligations, but also builders are there to sell, right? They're going to have to try and offload market or offload units. And if demand's softening a little bit, expect to see some more incentives. And then buyers, sellers, and investors on the sidelines. I think with all of the uncertainty, the quick change in interest rates, the quick change in values, people are still adjusting. And adjusting in real estate takes time, right? It does. I do expect that there are and I even see it myself with our clients. I have a lot of buyers, sellers, and investors just less motivated to work and do business in this environment because there is more uncertainty. And so if there is a fair amount of the market that's sitting on the sidelines, whether they're qualified and motivated or to do business or not, is, a lot of people just saying, we'll sit tight for now. Maybe we'll see what the market's going to be like in the spring. Whereas they can afford to do a deal now, whether it's an investor or buyer or seller, they may be more inclined to say, I want to see until I have more certainty on inflation and interest rate numbers before I make a decision.
Yeah. And by the way, that's not a bad thing.
Oh, no.
That's a healthy practice. Like we're getting back
for the last 5 years, it wasn't, but now it should have been, but it is a very healthy practice. Yes.
Yeah. Like this is actually how we forge sustainability in our market, which is actually more beneficial for everybody as a whole. Like a more balanced, a more sustainable approach to investing, as well as for the consumer. Like it is just so much more healthy for the country as a whole. And that makes it more predictable for investments. And like, yes, you get less of those opportunities where the market just like quickly bottoms out. You buy the bottom and sell the top. But most of us are terrible at doing that anyways, because timing the market's very hard to do. So it's just more predictability, more stability is not a bad thing for investors. And it's certainly not a bad thing for the consumers who want to get into the market as well. So, I'm encouraged by this rather than deterred. Like, this is a good thing.
Yeah. And I think that that's a big reason why Canada and real estate in Canada is like a really attractive investment, like just globally as well, is typically Canadian economy, Canadian real estate is typically a lot more consistent than a lot of the larger markets all over the world. And so like for me, like I tell people all the time, I'd rather be lucky than good any day of the week. And I was really lucky by getting into the business the time that I did, investing the time that I did, holding, flipping, and investing in real estate really significantly when the market was chugging up. I did very well. I appreciate that. But that was luck. Yeah, I did a lot of the right things, but the timing for how quickly the market was going up, which helped us make a lot of the money that we made, that was lucky. So my expectations is not to have that moving forward. And we'll talk about that in the kind of the mini case study that we'll go through for ROI and ROE after. But I think that it is healthy to have people, and it is, although I do not feel that we will have a sustainable real estate market moving forward for the foreseeable future. I wish we did, and I hope we make moves to do that. But yeah, I think it is super healthy. I think it is super healthy. All right, this is actually me. It's actually me on my crystal ball. I wish I had a crystal ball like this, whether it actually told me shit or not. Like, I would feel badass. I would feel badass, right? And I would tell my kids that it was telling me secrets too, for sure. Like, I would definitely, big old dad lie, be like, oh, it's telling me exactly what you've done. Here's my two schools of thought, right? Expectations, generally speaking, I think people are like overexcited about the prospects of rates coming down quickly, because that would be good for a lot of people that want to buy property or own property, right? So I think there is a little bit of a bias from people, a little bit of wishful thinking about how quickly and how aggressively interest rates may or may not come down. So I'm more on the side of, I'm going to kind of need to see it before I believe it. And I'm going under the assumption that rates are probably going to stay a little bit longer than all these wishers and hopers are probably going to think. I think if rates stay kind of where they're at now, which is the general expectation, I think for at least the next 6 months, wait for the Christmas season, wait for some more economic and inflation data to come in, wait for unemployment to figure out if it's going to find its feet. Expectation is we're probably going to be plus minus 5%-ish from the values and the type of market we're at right now. Inventory levels, asset values, how quickly things are moving, the general environment for the next 6 months, I expect to be very similar to what we're experiencing right now. That being said, Adam, if rates say, hey, we're definitely staying here, or hey, if we hit this mark, it's going down, and everybody thinks it's going to hit this mark and the rates are going to start going down, I expect there to be a fair amount of people on the sidelines pushing to get in ASAP. I do expect that as soon as they make an announcement that rates are going down, people will start to get a little wild again. I could see a little bit of a frenzy depending on how quickly. It also depends on how much inventory is on the market at that time. But general consensus and my expectations, the market we're playing in right now, generally speaking, is what I expect for at least the next 6 months.
Yeah, I think I would generally agree with you. I mean, there's no real reason to see a dramatic change in the rates, and nothing else is going to move quickly. So I don't see why it wouldn't stay pretty much the same for 6 months.
Right. And I think that a lot of conversations I've had from people is they're really excited at the prospects of rates coming down, because that's what's best for them. And I just really caution you guys as investors, as property owners, as thinkers, just think really critically. Like, I even catch myself doing it. You have a recency bias, just like Adam said, right? You have a personal bias. You know, you're special, you're different. Look, Adam, I love you. You're not special. Zach, I love you too. I'm not special. I'm not, you know what, like, just really think critically about what's going on in the economy. If we continue to yo-yo interest rates and yo-yo inflation, we are going to be back and forth just like we were in the 70s, and we are going to take years to find any sort of stability. That is a huge no-no for any economy. Finding a little bit of pain right now, if we come out of it nice and slow and consistently, it'll be better for business, better for new immigration, better for us in real estate. That's what I'm hoping for. That being said, if they say rates are coming down, Adam, get back on that horse, baby. Buckle up. We're in for a ride.
Yeah. I think that the market will respond in a very negative, like overall negative for economic health way, by just like ramping up demand if the rates go down. So I don't think that's good for anybody. And if it does happen, I think we'll all just have to deal with it. But at the same time, like, just as an investor, know that that's probably not good for you. Maybe you can take advantage of it as it happens, but at the same time, long term, it'll create a bit of a bounce. Yeah.
I really do appreciate the fact that you did say about like some sort of stability and sustainability in a market is healthy and is better for everybody. Like, I really do hope we do try and find that and make moves to make real estate, specifically in Ontario, just so much more sustainable. I just don't see it in the short term, but I do hope that people are making moves to do that. So that's my magic crystal ball. It's going to be perfectly accurate. We're going to play this in 6 months. We're going to have a big old laugh. Oh my God, Zach was perfect and he was right. And then I'm just going to.
Don't worry. The comments below will let you know if you're correct or not. Hey guys, drop a comment. How's Zach's crystal ball been so far?
Yeah, ping it so that when you get a comment, see we got no notifications, so you can laugh your ass off at how wrong we are in 6 to 12 months. But hey, I hope I'm right. I hope I'm wrong. All I know is that I want to make sure that I'm putting myself in a position and our people in a position to make a smart move, whatever that is. So one thing that we had a lot of attention on was a lot of our clients and a lot of people come to us, they've purchased properties kind of 2018, 2019, 2020. They've done really well on them. You know, the market since then, the market appreciated really crazy, kind of end of 2018 up to that 22, 21 mark. But the financing environment is totally different. Like we're looking at rates in the 6s now. They're at rates in the 2s when they're buying these properties. The asset values is almost half. Like we're talking big changes. So one thing that we've done, we analyze our portfolio at least once a year, right? Especially when we're looking at making a new acquisition or we're up for a refi, or like say, you know, in one of our multi-units, we just get a bunch of vacancy in a year. Okay, should we be refining that? Whatever. And understand the difference between our ROI and our ROE was like, oh, we started looking, we had a ton of equity kind of trapped in some of our properties. And since the new lending environment wasn't really sexy, it was kind of, you know, we were looking at our, you know, next 5-year projections. And we noticed some stuff. So just quick numbers. And Adam, I said before we got on, I hate going over number examples because I just don't want people to be like, oh, these numbers aren't accurate. Oh, I can't follow them. This is just a quick example, hypothetical. I went back and fact checked numbers for rental rates and prices kind of during 2015 or 2018, 2019 in my market. These are fairly accurate for what like a single family purchase would have been, right? A lot of people could still buy nice single family homes, new townhomes, semis, small detached homes, and buy them with 20% down and rent them out and like carry them or make a couple $100 a month. Freaking perfect. Great. Lots of investors were doing that in KW at the time. For this one, $500K purchase, you're putting 20% down, so $100K down, $10K for closing costs. You got a $400,000 mortgage. At the time, $400K mortgage would only cost you about $1,800. Hallelujah. And only $300 to $300 for your property tax, $100 a month for insurance, give or take. Single family home, tenant pays all the bills. You're, you know, $2,200, $2,300 a month it's going to cost you to carry the property. You rent it out for pretty much the same at the time, right? A lot of people were buying townhouses in Waterloo Region at the time because you could pretty much carry them with one tenant in there with just 20% down. All right. So like, nice. I can buy a pretty new townhome, carry it. I'm going to sell this in 5 to 10 years. After the market's up, I'll pay off a bunch of the mortgage, win-win, right? A lot of people are doing this. And I ran these scenarios for people that did like duplexes, triplexes as well. Different numbers, but very similar rates of return and very similar scenarios. So a lot of people have been coming to us and saying, hey, you know, I got this duplex or I got this fourplex, I got this sixplex, I'm up for a refi. Here's what my numbers kind of looking like. What are we doing? Well, if you bought that $500,000 property, it's about $800K, $750 to $850K, give or take now. Your current mortgage on it, when you're up for renewal, is about $360-ish after you've paid down about $40K. So you have about $440,000 in equity. Okay. Most of that is from the appreciation. Hell yeah. Well, good for you. Your profit on that is $330,000. You made $330,000 on your $110,000 investment. Good for you. Atta boy, atta girl, you're making some bank. I like to see it. Where a lot of our investors are running into the problem is the new refinance just sucks. The new refinance, sometimes it just like either doesn't make it work or you have to leave too much equity in the property to make the numbers work on a monthly basis. So you're not shelling out money out of your pocket every month. And so your current rent, let's say you get a tenant turnover, you've raised it every year. You know, you're about $2,600 for a small detached or a, you know, a smaller townhome or smaller semi. You could probably get closer to $3,000 current market rent, but that's if your tenants moved out like last year or the year before. So I don't want to assume that, right? Your new mortgage is at least $2,300. That's if you get a 30-year AM. Worse if you get to 25. Your tax and insurance about $400 a month. You're generally speaking, you're break even to out $300 or $400 a month. Right. And if you're about break even on a single family home, most investors will tell you this. If you're break even on a single family home, you're really out every month. Let's get real. You're running your numbers so they're kind of making break even sense and then you're going with it. But the reality is stuff's going to come up, right? Tenant's going to be late or not pay. You're going to have to do some repairs. You're going to have to do some maintenance outside. You're going to have to replace the furnace, a window, like this stuff happens, right? So we're seeing a lot of our clients just kind of get their monthly cash flow gobbled up if they want to take out any of their equity. or if they don't want to reposition their properties and the new financing environment doesn't really work for them. So on a refi, it's kind of challenging. So what we looked at was we looked at our return on investment and our return on equity if we weren't taking out significant chunks of equity out of our portfolio. And then we started running that scenario for clients in ours in their portfolio. And basically, if you held the single family home that's worth 800 grand a day for the next 5 years, you put a new 5-year mortgage on it, appreciate about 3% a year. Adam, I've gone over 3% a year on my portfolio just because the market was so hot, but I usually run this at 2% a year. I'll take appreciation if I get it, but I typically don't run it even at 3%. But at 3%, after your appreciation, after you pay down your debt, you make about 132 grand at the end of the next 5 years. So that would put us 2029, give or take, 2028, 2029. You're making 132 grand, another 132 grand on top of the 110 grand you invest in the property. You're about 120% overall. Okay, 120% is not awful, but you have 300 to 400 grand in equity tied up in this deal. If I run the return on equity on, I make 132 grand on the 440 grand in equity I have in the property, my ROE is like 30%, like 6% a year. And it's just like, shit. I like more than 6% a year. My ROE should be way more than that. My ROE for the first 5 years was like way higher than that. And so I got to figure out a way to recapture that. And so a lot of our conversations has been along, well, what are your long-term goals? Do you want to just plow down and pay down that debt because you're headed for retirement and you can just live off the cash flow for your properties? If that's your goal, then yeah, just start hammering down the debt. Great. But a lot of people, myself included, I'm ready to continue to grow. And so what we're doing is we're repositioning a lot of our portfolio, either refinance, reinvest in current properties to add more units or to improve the existing units. We're also going to be looking into selling some of our portfolio if it makes sense, right? And so these conversations we've had with ourselves every year since we've been in the business, we're starting to have much more of those with our clients, our past clients, and our network. And so we'll analyze the portfolio and our goals. We'll look at, okay, do we want to grow more units? Do we want to grow more monthly cash flow? Do we want to grow more in equity? Like, are we just trying to build net worth? What is the specific thing I need for my investment for the next 5 to 10 plus years? And then does it make sense to refinance equity out of properties and redeploy it? Or does it make sense to sell and put in a bigger deal? Does it make sense to just keep it as is and paying down the debt because I'm making fat cash flow and that cash flow will offset the higher lending costs for the new refi? So these are all scenarios we've run for all of our properties in our portfolio. People come to us too. And one thing that we really realized, we've already started, but we're really focusing on moving toward the bigger deals, right? Where you can get the similar types of ROI and ROE for the first 5 years of that single family or that duplex or that triplex purchase. If I sell one of my smaller multi-units and go use all that equity into one bigger deal, it's like just add a zero behind it, baby. And so the bigger deals are something that we're focusing on. We've worked with partners in the past. We've helped clients in the past as well. Us personally, there's just a ton of opportunity in that space. Now, I also wanted just to make a comment on the multi-unit market. And I think we talked about this briefly off camera in the last video we did but the multifamily market is adjusting differently than the single family and the duplex triplex market, right? Like I haven't seen, and I know a lot of other investors looking at this, if you own apartment buildings with larger multi-units, or if you're looking at acquiring them, you're like, Zach, the prices haven't really come down that much for multi-units.
Yep.
We haven't, not nearly as percentage-wise, not as much as those single family homes have, right? And so what's happening is a lot of investors are holding on to their multi-units because they don't need to sell them. They don't need to sell them. But like any deal, Adam, you search for the motivated. There are people out there that are selling multi-unit properties that are motivated to get a deal done in any market. It's just a little bit trickier right now. So what we're focusing on is we are looking at every larger deal we can get our hands on. We're looking for ourselves. We're helping clients. We work with partners for these deals as well. And I think there's a ton of opportunity in that space in the next 5 to 10 years as that becomes a really common asset class for a lot of larger investors as well. The value of those properties will continue to appreciate, and the value of them is much more predictable. Straight up, how do you value a larger multi-unit?
Yeah, I mean, it's just based on income, right? And income through multiple units is really secure for you because if somebody decides not to pay or they lose their job or whatever, you find yourself in a cycle of eviction or something like that, like that's actually okay in a larger multi-unit building compared to a single family house that you're renting out. If you're renting a single family and they stop paying, you're going to get hit with the mortgage payment, the taxes, insurance every month, and it won't stop. And, you know, an eviction process today might take 6 months, might take 12 months. It could take a while. But with that multi-unit building, you know, if you have 4 or 5 other people contributing to the actual cost by way of paying their rents on their units, like that person that stops paying or that instability in the market just gets absorbed. And that's again why we're talking about, because you and I got torched in the comments on one of our last videos because somebody said they were searching for multi-unit families and they were saying, or multifamily units, sorry. And they were saying, you know, the price hasn't really changed on these. And it's actually what we've been talking about is just the stability in that asset class comes from the ability to have multiple streams of income under one roof. And the reason why those don't just dump is because the people that own them, generally speaking, are using those buildings for cash flow. And so when the housing market becomes dried up or it becomes harder to purchase properties, the rental demand goes up, which increases rent, which increases the income to those multi-unit buildings, which makes them an even more stable asset class during times of instability. So you're not going to see those big swings in the multifamily properties. And to Zach's point, though, there are still motivated sellers, right? There are still instances where perhaps you don't even get the best price because it doesn't make sense because the income's so good on these buildings. But maybe now you actually just negotiate for better terms, like creative financing strategies through the seller. Maybe you negotiate in some vacancies. Maybe you get early access to the building so you can renovate a unit and have it marketable and ready to rent by the time you're actually closing it. Like there's all sorts of ways you could structure a deal today.
Little nugget right there, baby.
Yeah, it's totally feasible that you could find a larger multi-unit property right now, even though their price hasn't corrected a ton. That still makes sense for you.
Absolutely. And I just think like for us, we built our portfolio on small to medium sized stuff. Right. And so now, and a lot of people do because it's believable, it's manageable. You don't need millions and millions in cash to go out and do that. But you run into the financing and acquisition and management wall. It's easier to finance one 20-unit building than 21-unit buildings. It's way easier to get financing for that. It's also way easier to acquire. I don't have to go and find one 20-unit deal instead of 20 single-family homes that match my profile, right? So just the financing and acquisition alone, Adam, so much more sustainable, so much more consistent in that space. And then the cash flow insulates us as investors, insulates us big time. And then just the management, again, easier to manage one 20-unit building or 21-unit building scattered throughout the city. With the 120-unit building, I can get one person on one site to just do everything there for you. You're good to go. And so logically, it made a lot of sense. I think that we were already in the headspace to go out and move up into that. But just looking at our ROI versus our ROE and the market that we're seeing now and where we think it's going to be in the next 3 to 5 to 10 years, I do think we're slowly going to continue to become more of a renter's economy, slowly but surely. Every year, more and more people can't afford to purchase. That gap becomes bigger and bigger. Affordability gets worse and worse, which means there's going to be more people that are going to be stuck renting or tenanted because it makes sense for them financially. That's only going to keep the rental market strong, which will only keep the cash flow for the multi-units that I'm acquiring and owning up and up and up, which should support the values so I can continue to pay off my debt or refinance it and reinvest it. And so there's a big shift for us, like as our own portfolio, is we just like the light kind of went on last year and we made a lot of moves to start making that happen here. And it's been awesome to have these conversations with other people on the Canadian Real Estate channel and past clients of ours that are thinking the same way. So that's been a lot of fun for us. So if people have questions about like, Adam just rhymed off a couple awesome little tactics on like negotiating specific things because he's done this a bunch. And that's the fun part. The negotiating the deals actually typically, it can be the most insanely frustrating, complicated, annoying, but also just the most rewarding because you get a chance to get something done with somebody and you're going to acquire an asset that can make you a ton of money. And that's exciting to me as an investor. So like if you have questions about portfolio analysis, how to buy bigger deals, how they're financed, Adam is a wealth of knowledge as well. My personal contact information there, text me or send me an email. We have the event details. Links in the description for the ADU event that we're doing. But most of December and January is helping prep ourselves and our clients for their new year as well. right? Like a lot of people are doing their year-end planning, what their goals for the new year are going to be as well. So we do that with our past clients. If they're interested, and people that reach out to us on the Canadian Real Estate channel and the investor hot list, open invite for a portfolio analysis or a conversation about your goals. If you're not kind of figuring out what your goals are, you don't already have them, it's going to be really hard for you to grow. I'm a big believer in keeping your goals. Like, I have mine in front of my freaking face. I got them in my notepad beside me. I got them on the whiteboard behind me, right? And these are things that I look at. So a big value add for us has been able to communicate, hey, here's what we're doing in our portfolio. Here's what's worked, here what hasn't. Happy to apply that if people have questions or concerns.
That's awesome, Zach. I really appreciate it. And just before we let you go, one donut recommendation, because I know people are working on New Year's resolutions right now. You're going to be signing off on those, but before they get ink on the paper, we need one donut reco.
Okay. I'm going to go with the sneaky one here. Lucero on Ontario Street, downtown Kitchener. It's at Ontario and King. Great coffee shop, but they do Berliner style donuts. Okay.
Oh.
Yeah. Oh, yeah. And I'll give another one. Saturday mornings at the Walper. I don't know if they do it anymore at the Walper Hotel. They got a cafe on the second floor. There's an old German Dutch guy that does them from old Nona's Recipe. I swear to God, this is like 200 years old. He does Berliners there as well. That's two. The Walper and Lucero in Kitchener.
Okay, the Walper and Lucero and Kitchener. I appreciate you, Zach. Thank you again for this market update. It was really nice to talk with you. Guys, this has been the Waterloo Market Update. I'm Adam JD Martin. Thanks for coming back to the Canadian Real Estate Channel. Keep tuning in. We've got market updates all across Ontario, and we're going to keep hitting you guys with some great new content. So see you back soon.